All right, guys, welcome back for another video. In today's video, I just want to focus exclusively on Bitcoin and talk about some of the distinctions I'm seeing, what I think's going on right now, and what I think is going to happen, later on at the end of Q1 and Q2. Now, before I dive into it, I just want to start out with the idea that this phase of the market's very contentious between bulls and bears. People have very strong opinions, and I would just caveat that with basically since for the better part of 9 months since June of last year. Um, you know, Neither bulls nor bears have been phenomenally right. I mean, you could look at this white line as kind of a midpoint, and price has kind of been oscillating around that midpoint for 9 months. Now, of course, bears were phenomenally and totally right in late 2021 and 2022. I'm kind of the opinion that yeah, that some bears killed it, but I I tend to see this as capitulation has already happened in the market, and a lot of the best short position opportunities, are in the past. And that's just my personal opinion. Some people may think that, there's further capitulation, but I would argue that they should check, realized losses. I don't have that pulled up right now, but if you look at like the rolling average for realized losses, you can see that those actually peaked during June of 2022, basically right around where the market, kind of bottomed out. Now I know it did push a little bit lower than that level, um, you know, following the FTX collapse, but in the big picture, the market kind of bottomed out in this 17K, 18K region. Again, just my personal opinion. I think you can see the market kind of building RSI divergence. You got multiple drives of divergence on the weekly chart, something that Bitcoin has never had. So we mark this off right there. You can see now it didn't confirm this drive until you took out these highs right here, right? So this isn't confirmed as a low on the weekly until these highs are taken out, and you don't subsequently confirm this divergence until you take out these highs. Now we can see that once those highs got taken out and once this got confirmed, the market started changing its state of delivery and started reaching for the highs, right? So I really see this with the context of what was happening earlier as kind of the break in structure. Some people may look at this, they're both pretty valid, and they're both operating lines that we can work with. Now it's also important to mark off this level right here. This is what somebody would call a shelf or a price pause. And really what it represents is the last area in the chart prior to this gap up here. So you can mark that off right there. Let's get a horizontal line right here. Horizontal line. Well, you get the idea. This high right there. And you can see Bitcoin came up, tested that high before this area of inefficiency above. And that's ultimately where we saw Bitcoin top out. Now you can get really granular with it and go down to a 4-hour and see it, price came up to that level, touched it, sold off, sold back off into this level right here. Mark that off. So price comes up. Again, we'll go to the weekly chart. Price comes up, runs up to that level, comes back down, tests into this level. And this is a similar price distinction as what happened right here. So price came down, tests into this area here. Price comes up, hits that level, comes down, tests into there. So I took a trade here. I took a long right there. And I also took a long here on the retest of this level. I didn't, I did nibble on a short up here, but I didn't get, a proper short position to catch this move. Honestly, probably because of my bullish bias. But I did, capture the long side, just didn't effectively capture the short side as well. So you can see this kind of pattern of self-similarity playing out where you test down here, run up above, test into some old historic resistance. But again, if you have this line marked on the chart, right, if we go back to the weekly, you can put a line here, but really you don't know that, sellers are going to step into the market until you actually see them step into the market. And you ultimately did see them step in the market here, right? So price runs up to that level, tags it exactly, and you get a very big reaction off that level, right? There's your confirmation here that this actually is an area of resistance. So again, I know it's a little bit of a nuanced thing, but I do think it is important, right? You do want to see sellers step in at resistance or buyers step in at support, because otherwise, otherwise it really is just a line on the chart. But once we see that, you can see clearly that this area does operate as resistance. You get a test up kind of into that level, sell off, test up into that level, sell off back into this area here, run up, run back above these highs right here, stop run. This is a very, very classic entry for a move. And again, I didn't catch it properly, but whenever you have a stop run of a low time frame level into a high time frame area of interest, that is going to generally be a very high probability setup, because generally, before a big move, the market will generally run stops on a smaller time frame um, prior to making the move. So you get the run up, come back down, test this level right here, and then you can see here that the market is starting to change its state of delivery. Take out these lows right here. You get a little period of volatility contraction here. Now, really, this area here was kind of the area that was important, right? You can see price came down, tested off this level here, and then buyer stepped in at this level right here. You can see price came down, hit this level right there, and buyers reacted again, pushing price up very, very quickly, right? I think that's important, right? This is how you know that a level is significant based on the reaction off the level, right? So whereas we reacted very significantly off this level here down to here, and then reacted very quickly off there, you can see came back down to this level, reacted. So, buyers stepped in at this level right here, and when price returned to this area of consolidation, buyers defended that level. Now, again, it's not exactly the same level, but it is this area of consolidation formed prior off this level right here. So I think that's very important. Again, so then you get a run up, break down. It's really when this level gets lost here that you kind of get that gap slip. And, this is kind of really when the liquidation engine starts rolling. You get that really wicky price action right there. And filling in this area of inefficiency. Now, not filling it completely. It didn't test into this level right here. Really to fill the entire inefficiency, you would need to test into these bodies right here. But those are levels that I got marked off in the chart because, if price does reach down for those levels, then I'm going to be looking at longs. If you go to a daily chart, I think people are getting bearish here, but I mean, like this is very clearly a daily trend. I just don't. I understand that people are looking at the higher time frames, but um, I think if you really did want to get bearish on a high time frame level, then you would want to see the daily align with you as well, and that would be this level right here. If 21,600 gets taken out, then you really this starts to look a little bit different, and you're looking, I believe, more for a retrace down into this area of inefficiency. So you can really take it level by level, right? I mean, at this point, we've got a clear trend, price filling this inefficiency, coming down to an area of support in a uptrend. You have a clear invalidation right here with a clear area of inefficiency right here. So this area right here represents a high risk reward level on the long side. When it gets broken, then it doesn't necessarily constitute a good entry. But, if you were to break that level, then all of a sudden you could start looking for bearish retracements on, whatever given time frame you're looking at. So this just from like a high time frame perspective, this area is really where I'd be looking at to invalidate my bullish bias. Or put another way, I would still hold spot Bitcoin. I would look to accumulate spot Bitcoin because I'm always accumulating spot Bitcoin, but I would under no circumstance have any leveraged long Bitcoin exposure below this level. If you were to say get a daily close below this level. Now, again, whereas this area constitutes a very high risk reward opportunity on the long side, it doesn't necessarily constitute a good entry if it's broken. Um, that's a nuanced thing there as well. But it does, start opening the door to bearish retracements. So you don't necessarily know how much lower than this low it would push. You could just get a brief run below down to 2111, or you could push all the way down to 20,000 before you put in an intermediate low. So let's just say, again, we're getting a little bit ahead of ourselves, but just for the sake of argument, let's say that price did invalidate this level right here, ran down, maybe you got an area of support right here, and it runs onto this level. Now all of a sudden, if that were to happen, I would no longer be looking for um, longs. I'd be looking for shorts on a retracement to hedge my underlying exposure. So that's, again, kind of nuance as well. And I am getting several steps ahead of myself. So I think it is important to kind of focus on, what's happening in the chart. And as of right now, we don't have that invalidation, but it is important to keep an invalidation level on the chart so what you're going to do, no matter what price does. That can, it generally takes the form of, creating as many if-then scenarios as possible. By that I mean, if price does X, then I'll do Y. One of the reasons why I'm sort of biased to the long side is because this area really does represent um, the last line in the sand prior to this massive gap fill above. And admittedly, I was getting a little bit too bullish up here, kind of expecting a break above, and that position ultimately collapsed on me. That's kind of how the biases work on your own interpretation. But I think it's still that distinction still stands, right? If this area gets broken, if Bitcoin reclaims 25K, even 25.2K, then now you're in a situation where you know price can move very aggressively. So that kind of adds on to my looking at this area as very favorable risk reward opportunity on the long side, right? Say you get a test down into 22,000, you got your invalidation at 21,000. Say you get a daily close. That's $1,000 in risk if you have a one Bitcoin position for potentially, I would be looking personally up for a run up to this gap to be filled, at the very least to 34,000, 36,000. So you're looking at, like a 15K reward for a 1K loss. That's really how I'm viewing this. That's why I'm bullish to the long side. Now, part of that inherently is kind of, looking for resistance to break, which obviously didn't happen in the past. And there's no guarantee that resistance will break. But again, just how I'm personally looking at the market and personally positioning myself, it may be a good idea if you do have a long position to at least hedge it, right? Because the kind of inherently, right, a hedge is hedging yourself against your idea of being wrong. Um, hedges basically, one other way to describe it is, I was building a long position up here, looking for that break above, and the position ultimately collapsed on me on that move down. But because I had hedged myself, I was still able to, not face a significant loss. I was still able to eke out a little bit of profit, even despite being on the wrong side of the market. So it's always a good idea to, put your hedge in the market. Say you are long here and price does rally back up. Say you grabbed a long from down here and price, rallies up, you might want to put a hedge in the market kind of when price is getting around the 618, getting up into that higher premium. Now, again, we don't necessarily know. The price hasn't put in a low yet. So in that sense, we are kind of getting ahead of ourselves. But again, I do like to run through the probabilities of different scenarios unfolding, just because, that's the reality of the market. If you entertain all possibilities, then you really start to put yourself in a position where, no matter what happens, you're still able to pull out a little bit of profit from the market. Now, with that in mind, that does entail considering the perspectives where your idea is wrong, right? So that's why I am focusing pretty heavily on this invalidation here. If 21.5 gets lost on a daily close, then I drop my long bias. I start looking for short positions, hedges, because you never know. I mean, I'm particularly not very bearish. I know there are people who are looking for new lows, and even though I don't think that's a high probability scenario, it certainly is possible. But of course, invalidation levels have to get hit first. So uh, I know I've been saying it constantly this video, but sometimes you got to just look at, rather than getting caught up in what could happen or what would happen or what should happen or what has happened, right? When people are looking at the macro chart and looking at all the price action that has occurred, a year ago, even 2 years ago, rather than getting caught up in that, I just want to focus on what's happening right now and take it level by level. I still have this pretty big, long position, 970 long position, opened basically from this area here right before volatility expanded. And you can see here's all the profit and losses. Took a big profit right here. Profit. You can see there's some losses too, but primarily that was dynamically managing a hedge, especially when the market was expanding pretty dramatically. Yeah, anyway, I hope you guys like this video. If you guys haven't subscribed already, please make sure to do that. And I'll catch you guys